let me ask you something honestly, and I want you to actually think before you answer. Have you ever bought a stock because someone in a WhatsApp group said it was going to double? Or because you saw it trending on YouTube and felt like you'd miss out if you didn't jump in right now? Go on, be honest. Nobody is watching. If the answer is yes, you are not alone. According to NSE data for fiscal 2026, a staggering 69% of active retail investors in India traded for 10 days or fewer in the entire year. 10 days out of 250 trading days. Most people who call themselves investors are just reacting to noise and wondering later where their money went. Picking the right stock is not about luck. It is not about tips. It is a process, a checklist, a set of questions you ask before putting a single rupee of your money into any company. And today, I am going to walk you through exactly that, step by step. My name is Shivani. Welcome to Shivani Talks Money. Let's get into it. But first, I want you to do something right now. Think about one stock you currently own or the last one you bought. Got it? Good. Hold that stock in your head throughout this entire video, because by the end, you are going to know whether it deserves to stay in your portfolio or whether it is time for a very honest conversation with yourself. Now let's talk about the three types of stocks you need to understand. First is growth stocks, where companies are expanding fast, reinvesting everything back into the business, rarely paying dividends, huge upside but real risk when growth slows. Ask yourself honestly, am I okay with this stock doing nothing for 2 or 3 years before it moves? Second is dividend stocks, which are stable, mature businesses that pay you a portion of profits regularly, just for owning shares. In India in 2026, where FDs give 6 to 7%, a company paying 4 to 6% dividend yield on top of share price growth is genuinely powerful. Coal India yields over 6%. ONGC consistently delivers 5% plus. ITC has an ROE of nearly 48% and ROCE of 57%. These stocks pay you like a salary without you selling a single share. Ask yourself, do I want income now or am I building for later? Third is value stocks, which are fundamentally strong companies whose prices have fallen below what they are actually worth. Bad quarter, market panic, sector out of fashion. You buy a rupee for 70 pays and wait. Classic Buffett. Ask yourself, do I have the patience to hold something while the market ignores it? Quick task. Which type of investor are you? Growth, dividend, or value? Drop it in the comments right now. I read every single one. Let's talk about step 1, which is understand the business before you open screener or money control. Answer this one question about that stock in your head. What does this company do, and how does it make money? Try it right now. Pause if you need to. If you cannot explain it in 2 sentences, do not invest in it. Warren Buffett calls this the circle of competence. You cannot evaluate what you do not understand. HDFC Bank lends money and charges interest. TCS writes software for large global companies. That is it. If your answer sounds like, I think they are in chemicals and someone said it will 3 times, that is not investing. That is a lottery ticket. Your task. Open your stock app right now. Pick your top holding. Write 2 sentences. What does it do? How does it earn money? If you struggle, that is your answer. Let's talk about step 2 now, which is check profitability. ROE and ROCE, 2 ratios. Memorize them. Return on equity, ROE, tells you how efficiently the company uses your money to generate profit. Return on capital employed, ROCE, tells you the same but for all capital in the business, including borrowed money. ROE above 15% is good, above 20% is excellent. Same benchmark for ROCE. Go to screener.in right now, completely free. Type in your stock. Find the ROE and ROCE. If both are below 10%, ask yourself one question. Why am I still holding this? ITC's ROE is nearly 48%, ROCE is 57% as of early 2026. For every 100 rupees in the business, it generates 57 rupees in earnings. That is why patient investors in ITC have compounded quietly for decades, while everyone else chased the next hot story. What does your stock's number look like? Now, step 3, check the debt. I say this with love. This is the step that is going to save someone watching this from a very painful loss. Look at the debt-to-equity ratio. For any business outside of banking or NBFCs, you want it below 1, ideally below 0.5. A company drowning in debt is one bad quarter away from a crash. And those crashes happen fast, 40, 50, even 70% drops, before you can react. Here's the question to sit with. Is this company borrowing to grow or borrowing to survive? A company borrowing at 8% to fund a project returning 18%? Smart. A company borrowing new money to repay old money? That is a ticking clock, not a business. In 2025, this played out across the entire Indian market. Companies with clean balance sheets fell less, stabilized faster, and recovered stronger. Companies with heavy debt are still trying to recover. The data from Nifty PMS confirmed it. Strong balance sheets were the single biggest shock absorber during every correction. Task: go back to Screener. Check the debt-to-equity of your stock. If it is above 1 and it is not a bank, understand exactly why before you hold another rupee in it. Next is step 4. Is it fairly priced? P/E and PEG. This is the mistake that burned the most Indian investors in 2025, and it is still happening. The price-to-earnings ratio tells you how much you are paying for each rupee of profit. A PE of 20 means 20 rupees per rupee of earnings. The higher it goes, the more future growth you are already paying for, today, upfront, in cash. In early 2025, investors were buying stocks at PE ratios of 50, 60, even 80 times because the companies were growing fast. When growth slowed even slightly, those stocks crashed hard. The Nifty's forward PE corrected from 23 to 25 times, all the way down to 19 to 22 times across 2025, wiping out years of gains for people who bought at peak optimism. The smarter tool is the PEG ratio, P over E divided by the earnings growth rate. Below 1 suggests potential undervaluation. Above 2 is almost always overpaying. Quick, honest question. Have you ever bought a stock just because it was going up without checking what PE you were paying? Drop an honest answer in the comments. I promise you are not alone. Task: look up the PE of your stock right now. Is the growth actually fast enough to justify that price? Never buy a story. Buy a valuation. Let's talk about step 5 now. Check the management. In India, promoter quality is everything. When you buy shares in an Indian company, you are trusting the promoter with your money. The question is, should you? High promoter shareholding with profits being reinvested into the business? Great sign. They win when you win. But a promoter pledging their own shares as collateral to borrow money elsewhere? That is a red flag. Financial pressure outside the company always bleeds into the business eventually. Here is a task that takes 15 minutes and could save you from a catastrophic loss. Google the company's name plus the word SEBI. Any investigations, sudden auditor changes, related party transactions where company money flows to the promoter's private businesses? These are all on public record. Most investors never check because checking takes effort and trusting a tip is easier. When FIIS pulled 1.61 lakh crore rupees out of Indian markets in 2025, weak governance companies got hit hardest and stayed down longest. Trust in management is not a soft feeling. It is one of the hardest numbers in your investment decision. Moving on to final step now. Step 6. 4 mistakes that are destroying your portfolio. Be honest with yourself as I read these. How many are you guilty of? Mistake 1. Chasing last year's winners. Mid and small caps soared in 2024, attracted huge inflows in early 2025, right before a sharp correction. Late entrants paid for everyone else's party. Look at your last 3 stock purchases. Did you buy after the stock had already run up significantly? What was your actual reason? Mistake 2. Panic selling during corrections. In early 2025, SIP stoppages exceeded new registrations. People stopped investing precisely when accumulating more units at lower prices would have been the smartest move. The market recovered. The people who stayed in came out ahead. How did you react the last time your portfolio fell 15%? Mistake 3, no exit strategy. Alok Jain, founder of Weekend Investing, puts it directly. Most Indian investors do not lose money by picking the wrong stock. They lose money by not knowing when to exit. Right now, pick any stock in your portfolio. What is your exit price if it keeps falling? If you do not have an answer, you do not have a strategy, you have a hope. Mistake 4, no diversification. One sector, one theme, looks great when it is working. When the cycle turns, it becomes a disaster. Check your portfolio right now. Is any single stock above 5 to 6% of your total equity? That is concentrated risk dressed up as confidence. How many of the 4? Drop the number in the comments. That number is exactly where you start fixing things. India's growth story is real in 2026. GDP at 6.5 to 6.8%. Government deploying 11 lakh crore rupees in capital expenditure. Over 8 crore unique investors on NSE. The opportunity is absolutely there. But opportunity without a process is just gambling with extra steps. Now, the final task. Take that stock you have been holding in your head since the very beginning of this video, run it through all 6 steps right now, write it down, and ask yourself, does this stock actually deserve my money? If yes, you now own it with conviction instead of just hope. That is a completely different relationship with investing. If no, that is not a loss. That is the most valuable thing this video could have given you. Like this video if it changed how you see your portfolio. Share it with someone investing on tips right now. It might save them real money. Subscribe to Shivani Talks Money for honest, research-backed finance built for real Indian investors. And go watch our video on how much you actually need for 50,000 rupees per month in dividends. The link is on your screen. I'll see you in the next one.